Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, March 2nd, and I'm recording this from our studio in Purchase, New York. February probably couldn't end soon enough for investors in U.S. technology shares. Since the NASDAQ composite peaked near the end of October, the mega-cap tech stocks have fallen about 8%, and the software sector is down close to 30%. Meanwhile, tech contagion has driven financial stocks down around 5% and the big banks down as much as 10% year to date. The drop in tech has created some market anomalies. For example, the tech sector's price-earnings premium over that of the S&P 500 has shrunk to a 5-year low of roughly 10%. Just as eye-catching, tech's forward price-earnings multiple is currently equal to that of the consumer staples sector, despite tech's far higher growth rates. How should investors navigate these seeming contradictions? Well, starting with the Magnificent Seven and the hyperscalers, rising CapEx has become a material concern that may justify the repricing over the past few months. After growing 70% last year, CapEx for the next 3 years is expected to exceed $2 trillion, according to Morgan Stanley & Co. research analysts. In fact, the CapEx to sales ratio suggests that the capital intensity of the AI revolution is on track to surpass that of the internet era. This raises the question of return on investment for these companies and the potential for falling margins and negative free cash flow growth. That said, relative valuations are attractive, and as the Mag 7 become more idiosyncratic, dispersions in valuations may create opportunities. In contrast, the sell-off in software seems to be based less on facts than on fear, specifically the fear that Gen AI will make software business models obsolete. While we understand the logic, the sell-off has been extreme. Software has underperformed semiconductors by some 70 percentage points. Currently, the sector has a forward price-earnings ratio of 14 times, implied earnings growth of only 7% per year, and returns on invested capital of more than 20%. In our view, there are opportunities for selective stock picking at a minimum. Finally, in the financial sector, concerns over software exposure in direct lending ring true to us, particularly in private credit. Private credit strategies are opaque and leveraged, which can amplify their risks. Also, older private credit vintages and evergreen vehicles may hold loans that were made to software companies before Gen AI, and these need to be reevaluated. The megacap banks, unfortunately, are being tarred with the same credit risk brush. But in our view, the risk to big banks from software lending and AI disruption are far outweighed by the potential for gains from deregulation, AI adoption, and vibrant capital markets, which makes this segment a good hunting ground for stock picking. Putting it all together, the Mag 7 and the hyperscalers are undergoing fundamental shifts as AI evolves, and anxiety around that has rippled through the U.S. equity markets. We think some of the repricing is grounded in new information, but far from all of it, creating opportunities for selective investors. Consider focusing on earnings realization versus overhyped themes in the U.S., concentrating on oversold names with quality attributes in large cap core. These include select healthcare companies, the Mag 7, software, and mega cap financial stocks. Industrials and energy remain cyclical beneficiaries that can be funded by taking profits in consumer sectors. Add to the rest of world equities with a focus on emerging markets. Hedge funds, gold, and infrastructure remain key to our asset allocations. As always, thanks for listening. And for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.